Well, it's that important time of the year. It's boot camp season. I will tell you, the feedback we've gotten from you folks on the boot camp series has been so positive. And for those who don't know about the boot camp series, you can go to the homepage of paulmerriman.com and you can click on boot camp and it will open up. Now, right now, if you did it today, you would not see the piece that we're working on today, but we'll have a link to that obviously for you to see it. But here's what I know, that within a few weeks, maybe it could be 8 weeks, maybe 6, we'll have all of the articles, podcasts, and videos done about what we consider to be the most important investment decisions that you make. And those go from the range of stocks versus bonds to how you take distributions in retirement from beginning to end. In the one we're going to do today, we're going to focus on one that I think can make a huge difference in your financial future. We're going to be looking at the sound investing portfolios. And we'll be talking about those, talking about their performance. You will be able to see the tables here during the presentation on YouTube. But for those who are not on YouTube, we have links to all of these tables that we'll reference in the notes. But I want to take you back very quickly to 1994. I went to classes given by the people at Dimensional Fund Advisors. By the way, I forgot to mention, you see that I've got my friends here, Chris Pedersen and Daryl Bahls. I start flapping my mouth and I forget you guys are here to celebrate boot camp with me. But I went to classes and I don't know, Daryl, Chris, did you guys go to those classes at DFA?
I've been once. You got me invited early on when I joined the foundation, and it was fascinating.
Daryl, did you ever
Um, I
get
have
that opportunity?
I have not been, but I sat through I don't know how many of your all-day
Oh,
presentations in the late 90s, early 2000s.
sorry.
So I feel like I've been there.
Okay. Well, it was life-changing for me. And out of that, uh, we built a portfolio of 10 different equity asset classes and proceeded to teach people how to do it on their own. And in one of the boot camp segments, you will hear all about that particular 10 fund strategy. But that's when I retired in 2012 and I stopped being an investment advisor and spent my life teaching, purely teaching. I wanted to teach people what we had been doing for some 2,000 families in our business. And by the way, the business is still there and doing just fine without me. But I wanted to help people do what I had learned to do for others. And then Chris came along. Well, actually, Daryl came along before Chris came along. Daryl and I go back 20 some years, right, Daryl? Must be
The
at
first time
least.
I saw you, I think the first time I saw you speak was in Spokane in I want to say 83,
Okay. Well,
but
that's a while.
maybe
Uh,
it wasn't quite that long ago, but it was a long time ago. Yeah.
but Daryl came and worked, joined us here at the foundation, and took over the responsibility of taking care of all the tables and doing all sorts of studies that we've been able to share with you. And but then a few years later, and that started in 2014 officially, and then in 2016, Chris joined us. we were still plugging away, teaching people how to use 10 funds. But it didn't take long for Chris to come to the conclusion, and by the way, the same conclusion that some months later John Bogle came to when I met him, and that is that 10 funds is just for most people too much to deal with. It's fine if somebody is hiring an advisor and they do all the work. And so Chris, he went to work and developed a series of portfolios that has really changed the breadth of the work. We can help so many more people today than we could then. But Chris, I would really appreciate it if you would take a few minutes and give us some background on what you went through in coming up with these different portfolios, the testing you might have done, the ways that you determine, well, this one should be on the list.
Well, part of it was tied to the best in class work that we do, and part of it was tied to some of the buzz around the work that we do as a foundation at Bogleheads and other places. And all of the changes were kind of rooted in that training that you mentioned that we did at DFA. So what you learn when you start to get into this part of the world of portfolio construction is that what really drives returns is how much exposure you have to these different parts of the market, how much exposure you have to the market risk factor, the size factor, the value factor. And factor sounds really highfalutin and technical, but it's basically just attributes. You can think of, you take all the little companies, they behave differently than the big companies. And so if you own more little companies, then your portfolio moves like the little companies. It has a higher expected return, a little more volatility. Same thing for the cheap companies. And that's true whether you're looking at an individual fund or a portfolio. And so when you look at a portfolio that's made up of 10 different funds, you can characterize that portfolio by saying, well, how much does it have of small and how much does it have of value and how much does it have of market risk? And at the end of the day, even though it's got 10 funds in it, it's going to behave primarily based on those exposures. And there was a guy at Bogleheads named, went by the handle Trev H. And he had kind of taken issue with this 10 fund construction and said, you could get almost exactly the same returns with 4 funds. You just do US large, international small, US small cap value, and international large cap value. And you've got a fund, a portfolio that's still half in small, half in large, half in value, half in blend. And sure enough, if you took index funds that were in those asset classes with only 4 funds, and you looked at the returns, back testing, it looked almost the same as the ultimate buy and hold. So there was this kind of theoretical underpinning that said you could do this. There was a practical history that said, yeah, you really could do this. And then in collaboration with you, Paul, and Daryl, we had a lot of discussions about, well, how might you want to do this pragmatically speaking? Well, you might want to do all US. And so that led to the US 4-fund portfolio. And that has a practical advantage that we can back test it much farther back in time than we can the international asset classes. And so that one's kind of intriguing. You can actually create a portfolio just with small cap value and large cap blend that's still half in small, half in large, half in value, half in blend. So it's got the same kind of attributes. And sure enough, it behaves much the same way as these other portfolios. So what we really have are different simplifications that hopefully are useful to people who are looking for a way to get to a good return per unit of risk. And we thought it was valuable to give people choices. So we have the worldwide four fund portfolio, the US fund portfolio. We have the two fund portfolio. We still have the 10 fund portfolio. And they have different advantages and disadvantages that might appeal to different people, more or less control over how much is international versus US that's independent from the tilts to size and value. More ability to have regret avoidance of always being in the fund that's hot, because if you own the 10 funds, you're always going to be in something that did best last year. I think it's good that we give people choices, but I think it's also good that people understand that in the long run, the expected return of any of those portfolios that is half in large and half in small, half in value and half in blend it should be similar. They shouldn't be that different. So it really comes down to other intangibles that you would probably choose off of. But that's pretty much how we got here, and it was a fun little journey.
Well, and I was ecstatic, uh, thinking that people would finally be able to do this on their own, because the whole process of building our business back in the 80s and the 90s was based on teaching people how to do these things. But then if they didn't want to do it, we would. And I really wasn't going out of my way to make it complicated. I was just doing what DFA had taught us to do. And so it was a sense of freedom in a way, Chris, when you put that all together. And then we had to show people the implications of these different portfolios. And as almost always happens, when I asked Daryl if he could help me on a project, he comes back with something that just helps me teach the process in a way that I think people are going to get it. We all know that this is about staying the course for a long period of time to maximize our success. At least that's what everybody believes. So the better that you understand this, I believe, the more likely you are to stay the course. So, Daryl, would you give us the sound investing table? Why don't we start with the sound investing table that simply shows the different percentages?
So these are the what we call the sound investing portfolio. Well, sound investing portfolios down in the rows here. The S&P 500 is kind of a benchmark. Which is very close to the total U.S. market. The worldwide ultimate buy and hold is 10% of all these, however many of these are, 10 funds or more. 1, 2, 3, 4,
That's
5,
10.
6, 7, 8, 9, 10. Yeah. And then there's the worldwide 4 fund, as Chris mentioned, which is 25% large blend, US large blend, 25% large cap value, 25% international large cap value, 25% US small cap value, and 25% international small cap blend. And the US fund is where US 4 fund is just concentration of those 4 asset classes, but US stocks only. And then the 2 fund is down here, the 50% S&P 500, 50% US small cap value. There are a couple of more concentrated funds, 4 here, split between US and worldwide on the value side, whether it's large and small value or just small value. But so these are the major funds that are included in our sound investing portfolio suite, if you will.
And then the big page.
So we took these funds and thought about how best to sort of compare and contrast them and have a way for people to sense the differences between these different mixes and how to assess what they might be comfortable with. And so we developed the portfolio comparison table, if you will. We looked at the 10 funds and we compared them in terms of returns, compound annual growth rates over the 55-year period in this example, and then looked at them on the decade by decade basis. We looked at the ups and downs of the ride. How many years were you up here? And how many years were you down? When you were up, how much were you up? When you were down, how much were you down? How bad was the worst loss and how good was the best gain? And then we looked at the risk, which included standard deviation in terms of a measure of volatility for risk and a couple of other measures, which we won't talk to today. But and we looked at that for all 9 of these different portfolios. And it provides a nice, handy one-page look to compare some of what we thought were some of the key decision-making criteria across these different portfolios that would help people understand how they differ from each other and how they compare over the long term and how they differ over the short term being a decade in this case. So, and that's all compared or put together on one sheet. Helps you understand how things can change. Sometimes some decades are better than others, as you can see, and some decades are smoother than others. If you look at the standard deviations down below between returns, it's kind of interesting to see how, if you remember the ultimate buy and hold portfolio had an 11.9% return over the entire 55-year period, and the worldwide 4 fund has a 12.1% return. Very similar return. If you look at the decade by decade returns, they're very similar. All done with four funds. If you look at the average up year gain, number of years, very similar. Worst or best gain, worst down statistics, they're very similar. Volatilities are all very similar. So it's very easy to see how you can replicate essentially the 10 fund equity portfolio with just 4 funds. And you can do the same thing with the US 4 fund here. It's a little bit different, but not a lot when you look at the comparisons. They're all very, very similar. If you look at the two fund that compares the large growth with this, combines the large growth with small value, and compare it to the 10 fund, the performance is still very similar in a lot of these categories. Almost all of these categories, it's very similar, and it's done with just 2 funds. So,
And
Chris, go ahead.
if I can just chime in, I said earlier
Absolutely.
that somebody's expectations, should be similar for these different funds that are all balanced between large and small, value and blend. There are a couple of footnotes on that for the worldwide ultimate buy and hold. It has emerging markets, which the other ones do not. And it has REITs, which the other ones do not. So that could be seen as an additional form of diversification and defense. Sometimes Paul, likes to think about that as kind of a defense. It could help explain some of the drag on the performance over this period of time. That's not to say that it would necessarily contribute to a drag on performance in the future, but it's a difference. So there are some, I'll call them second order, sort of, not the top line driver of performance, but one notch down from that, drivers of performance that are different for the worldwide ultimate buy and hold from the other portfolios. But I think if you look at the compound annual growth rate, and Daryl was making this point, the percentage differences for these, I'll just take the US only ones. The US 4 fund, 12.2. The US 2 fund, 12.5. I can't tell you that is statistically significant. It may be because there's a little bit more concentrated small in value available in a small cap value fund than the value tilt you get in a large value fund or things like that. But they're pretty close. Yeah, they're pretty close.
This table allows so many different kind of investors to look at it and dream or plan or whatever the word is. And right at the top line, you showed people the number one thing they want to know is how much money would I have made? And you show that at the top, and you can see quite clearly that the S&P 500, the $10,000 investment turned into almost 3 million, whereas the two fund strategy turned into about 6.5 million, and the four fund US turned into about 5.6 million. So appreciably higher returns. And one of the things I would like to believe is the future will look like the past in terms of the premiums that investors get. Now, how big those premiums will be, we just can't know, but that there will be a premium for having a portfolio that has the broader diversification of equity asset classes. In my mind, it's not so different than a person wanting to have 500 stocks in their portfolio instead of one, and or 12 different industries instead of one. Whatever, however diversification is viewed, this is a powerful demonstration of the advantage of diversification. And for people who are worried about the downside, uh, Daryl just reminded me before we got started here today that he originally, in his original table, had focused on the number of down years. And that is the thing that causes people to give up. The size of the losses and the biggest losses cause a lot of people to sell, and how many losses, losing years. But you can see, I mean, the beauty of this is I can look at the S&P 500 and see the sum of all the down years was 159.2%. And the sum of all of the losing years of the 50/50 US S&P 500 and small cap value was 141%, which tells me that even though the volatility is going to be higher, probably, and it is in terms of standard deviation in the two fund strategy, the volatility of the standard deviation is measuring upside movement and downside movement. And in essence, they're all the same. But this breaks it out and says, I have a combination that should not, over time, might be a long time, but over time, look very similar to the S&P 500. We're not suggesting, by the way, that you should have all of your portfolio in equities. We're simply saying in the equity portion of your portfolio, these are all a possibility. And then the other thing that I just think is for people near to and in retirement, I would like your retirement years to be profitable, and because you're going to have some equities, or you wouldn't be watching this, I'm sure, some equities in your portfolio. And I would like the ride to never feel threatening. And one of the things I like, and this is only a few decades, but it's the decades that many of us know and live through and know how we felt when things were going terribly. When we look at 70 through 79, and if you could point that out, I don't know that I can point it. Oh, I can. Excuse me. Here, that 5.8% compound rate of return from 70 to 75 to 79. Well, that's fine. It was a nice decade compared to losing money like they did in 2000 through 2009. But a lot of people would have started in 1970, I'm sorry, in 2000, and have gone through a terrible bear market, a little bit of came back a little bit, and then another big bear market. But if you had been in virtually any of these strategies, you would have done significantly better. And I will tell you, from having been there and actually done it for clients during a period of time that was terrible. I was in the ultimate buy and hold strategy in that period of 2000 to 2009. And to be up 7.3%, when the market's down one, that's over an 8% a year difference. And it came at a time maybe when a person was just retiring. So I feel strongly that if obviously I cannot feel strongly to know enough to know what will happen, but I feel strongly that the continued strategy of diversifying more in your portfolio, still in index like funds, but more, I think, is going to benefit you in the long run. And I know we also, by the way, before we leave this page, either one of you want to say anything else? Let's current.
Just one thing I would point out is that the worst during this 55-year period, the worst year was all the same year. It was 2008 calendar year.
Yeah.
And the losses were pretty much the same. It didn't really matter which one you were in. They were all pretty much the same. Not that you would notice the difference. Probably not enough to notice the difference really if you were in them. But the up years are significantly different. The best up year. So it's interesting to know, as you mentioned, Paul, if you look at the ultimate buy and hold, the best up year it had was 2003, during the decade that the S&P was flat, basically.
Yeah.
That's when the ultimate buy and hold, and actually the worldwide 4 fund and the worldwide all value all had their best years in that decade, during that decade when the S&P was essentially flat over that decade. Anyways, sorry.
Actually,
Go ahead, Chris.
I would add just one thing, and that's that, especially since this is a boot camp video, for investors who are new to this space, I think it's important for them to understand why different parts of the market would thrive at different times. It's not just some magic secret sauce that small companies and companies that are out of favor do better under some economic regimes of inflation and government policy, fiscal policy, than companies that are large and in favor. It's true that some companies are going to do better when interest rates are low, and some companies are going to do better when interest rates are high from the standpoint of the return that they're going to get for an investor. And it has to do with how much their future earnings are discounted, how much they have to borrow, how capital intensive their businesses are. And if you just buy the total market, you don't get exposure to companies that are going to do well in different phases of the market. You just get big companies that are in favor. They're so large that they dominate the value of that portfolio. So when you buy one of these portfolios that has these different kinds of companies, you should expect that those different kinds of companies are going to do well at different times. And that means you have to tolerate what's called tracking error. Sometimes, the reason these returns are different in the same decades is that there are times when the S&P 500 is crushing it and you're one of these diversified portfolios and you're not. And you have to tolerate that, and you have to live through it. You have to take a different journey to get to a different destination. If you're not willing to take a different journey, then you're going to buy the S&P 500 and end up in the S&P 500 destination. Yeah.
And I think it's also important when you're looking at these tables to notice the differences in the good times for the S&P 500, whether it's the 2010 through 2024, the S&P 500 up 13.9, ultimate buy and hold 8.8, worldwide 9.4, US 4 fund 12.1, the all value worldwide 8.6, US all value 11.4, the worldwide all small cap 9.2, the all small cap 11.3, and the 2 fund strategy, that's half US S&P and small cap value 12.8. So in some ways you'll notice that the 2 fund strategy is oftentimes a lot like the S&P 500. But there are, like like Chris said, there are times the S&P 500 is crushing it, and it shows up here, but it shows up on another page that you'll when you eventually come to the boot camp page on the sound investing portfolios, you're going to see each one of these strategies 1 year at a time. You're going to see their return. We have that table for people who really enjoy that kind of thing. And one last thing about these portfolios. Um, the small cap value, it is not our intent to recommend that you put all your money in small cap value. On the other hand, you might have a Roth IRA, a couple of years of Roth IRA somewhere, that when you could do Roth IRAs, or uh, you were not in a 401k, however it happened, but you might decide you're going to put that money all in small cap value. And this will give you a sense of the potential from small cap value. Now, there was a time, and I hope I've got it here. I just looked at the periods, 50-year periods, I'm sorry, 40-year periods, starting in 1930. And I looked at the S&P 500. The average for that 40-year period, 9. The next 40-year period, it was 10. The next 40-year period, starting at 1950, was 12. Starting in 1960, 12. Starting in 1970, 10. Starting in 1980, 11. Starting in 1990, oh no, from 2000 to 2024, it was 11. Pretty consistent, really, over those periods. When I look at the small cap value over these periods, 12, 16, 17, 16, 15, 15, and the final from 2000 to 2024, 13.6. Yes, there is the possibility that it's not going to get 16, 17, 16, 15, 15 again. We don't know. But there will be people who will want to take a piece of money and just do small cap value, the two fund strategy, the worldwide all small cap value. They're there for a reason. They aren't there to try to entice people to put all their money in small cap value. Let's take a few minutes, Daryl, and let's look at 70-30. Please.
Okay, yeah, this table is 50% international. So this table is now 30% international, 70% US. So the one thing, and this will probably only work for those who are watching the video here, but there's not a lot of difference. This is, I mean, I'll flip back and forth between these here, these two charts here a little bit. So this is the 70-30. Watch your favorite portfolio and your favorite time period. Of course, the time period shouldn't change except maybe this last one here. So you can see, and I've highlighted the worldwide ones here. These should be the only ones that will change between these two. So you can see the worldwide 50-50, 11-9, worldwide 4 fund 12-1. That's a 50-50. If you go to the 70-30, it's 11-9 for the worldwide or for the worldwide ultimate buy, and 12-3 for the 70-30 internet US international. If you look down these here, the returns in this column here, this is the 70-30. That's the 50-50.
So
I feel like an optometrist here. Better or worse? Better or worse? So if you look at the differences here, you can see there is some difference. In some decades, things are better in the 50-50, and in some decades, they're better in the 70-30.
and
which
you'll
you would
find
kind of expect, actually. So
and you'll find in the all value portfolios, and there are several that there's an advantage to the 70-30. I think a lot of people are probably more likely to have 30% in internationals than 50. So you might want to spend your time at home looking at the 70-30 portfolios rather than the 50-50. But they're not life-changing differences. And so I think but I do think it's helpful to be able to compare what happens when you change that percentage of US and international. So, so the thing, of course, that's missing for many of you right now is the funds that we would use to fill these portfolios in the four fund strategy, which is 25% each, large cap blend, large cap value, small cap blend, small cap value. What ETF would you use for each of those? And the good fortune is that Chris Pedersen has taken the time to do the homework. And Chris, what would you guess? When do you expect you'll have the latest recommendations uh, on the best in class ETFs?
So the second time in two podcasts you've asked me that question.
Well, I was going to ask the reason here. I thought we would look for a date theoretically.
Yeah,
So
I last time I said by the end of February, and I agree with that still.
okay,
I'm doing the first step is fairly easy, but then there's always, the devil in the details. There's a lot of things that need to be scrutinized, and that's what I'm working through right now. And then there's the updating of all of the contents so that we can roll it out in a coordinated fashion.
yeah.
So I think by the end of February, there's a very solid chance that we'll have that already. And there are likely to be some changes this time around because there are a number of new offerings. And one of the tricky things is that some of them don't have very much history. And so there's a judgment call to try and figure out A, whether they're better, and B, whether we have enough information to be confident that they're better. And the other thing is in this update of the best in class ETFs, we're going to try to give people a feeling for how different the best in class ones are from the alternatives that we offer to try and make sure that everybody has a commission free choice. And in some cases, let's say a fund changes, it might be less than a percentage difference in expected return, and you may not want to take a tax hit in a taxable account to make that change. But it might be, several percentage in the expected return. I can't tell you how they're actually going to perform. I can just tell you based on how much exposure they have to different market attributes, based on that and the historical value of those attributes, what the expectation would be going forward. But I think it's still informative to have a number. And so we're going to try and provide a number that gives people an idea of how different things are. And then they can make a judgment call on whether it's worthwhile to make the switch or not. So I'd say end of February, we should have that. And I think it's going to be a nice enhancement on the process. And I think it'll be good news for our investors.
And by the way, Daryl and I have seen the first cut. And I love what Chris has added because it's going to give you an opportunity to see what kind of return difference there is between what you might hold and moving into the new recommended ETF. Before, people just didn't have a clue. And he's quantified it in a way that I think it seems fair and based on factor investing and the impact of the different factors. So I think you're going to enjoy that. I think you'll find that helpful in making some important decisions. So, gentlemen, you've done it again. I think this is the first boot camp piece that we've recorded. I am actually going to record on my own in the next week the ultimate buy and hold strategy. I think I can walk through each one of those changes, and that there's not so much that you can add there. It's easy for me to do it. I've been doing it for 20, 25 years or something. But this is great to get it started. And it's so much earlier than last year. And Daryl, thank you for getting things powered up so that we can have an early start in the year. So there you go. This is our best effort to try to head you on the right path. We'll have an article about the sound investing portfolios, and we'll have a podcast. Thank you all very much. I appreciate it, and share this with the people that you think it would be helpful. And if you will, direct them to our website, paulmerriman.com. And if you haven't subscribed to our YouTube channel, I hope you'll do that as well. Okay, thanks a lot.
I know you don't have enough to do, Chris, but
Have I shown you my to-do list?
yes, I know. Our to-do lists are always this long.
I showed Paul my to-do list.
Oh, geez, it looks like mine. So that maybe a little longer than mine, but of course, I've got a big chunk of mine done for the year. Neener,
Good
neener,
for
neener.
you.